Have you heard about runs on the banks? Banks failing, government stepping in to bail out? That's the problem. Let's actually now talk about the solution. Plenty of people are talking about what's happening, how it happened, and we can do that as well. But how about we get to a solution? I'm not talking about at the macro level. I'm talking about you. I'm talking about bringing banking back to the me and the you level. Let's talk about it. Hello and welcome to the Durham Talents channel. My name is Jesse Durham. Today we are going to be discussing runs on banks, the commercial banking system, these bank failures that we've been seeing, the government intervention, and most importantly, we're going to actually talk about the solution to this banking crisis, which is how to bring banking back to the me and the you level. And to do that, I'll be referencing, as always, R. Nelson Nash's book, Becoming Your Own Banker, the infinite banking concept. So let's get started first with some terms. I believe it's important to start with terms, definitions. So before 2015, before I'd ever read Nash's book, I'd never really considered the banking function. Looking back now, it seems just so basic, so fundamental. But I just didn't notice it. I mean, I was building a family and pursuing a career and just living life. And I think that's where so many people are at. So let's actually just start with the terms and put some definitions to these terms. So let's start with banks. Now, the way I like to talk about this is food bank, river bank, snow bank, blood bank, is just to think about what bank actually means, what it implies. Okay, so where there's a food bank, there's food being built up or collected or amassed, right? The blood bank has a blood supply. And that is just what bank means. That's just what it is, okay? Is a place, a location, a collection of something, whatever that thing happens to be. Snowbank, okay? That's where the snow's pushed up to the side of the road. Do you understand? I know you do, because that's so very simple. And this is a really simple concept. The fact is that you can become your own banker. Okay, so now that talks about the person. So we've talked about bank. Let's talk about banker. I'm saying it could be you for you, me for me. We don't have to rely on or abdicate our responsibility or our profitability to a different banker. We can be our own banker. Now let's talk about banking. And I hope this isn't too nitty-gritty for everybody, okay? The verbs and the nouns, etc., okay? But banking is a process. Banking is a function. Banking just is. So again, before I recognized it in 2015, I had been banking one particular way. Well, two, actually, if you say commercial banking and then paying cash, and we'll address both of those approaches to banking in a second, and why becoming your own banker with the infinite banking concept is superior to commercially banking or paying cash for things. But banking exists, is what I'm trying to draw our attention to here. Banking is a process, it is a function, and someone controls it in our lives, someone profits from it in our lives, and we can't even begin to address the whole concept if we don't even recognize that it's there. So banking is. Now we can talk about how everything is financed. For sure, everything is financed either commercially, and that's where we go into a bank. And let's say we're going to finance cars, just for one example. We could be talking about anything because everything is financed one way or another. But let's just say we were going to commercially finance vehicles. We go in, we submit our papers, our blood work, donate a kidney, give away the rights to our firstborn, whatever it is. We got to go through that process and see if we qualify to use the bank's money. The bank's money. I should use air quotes there. That's so funny. But we have to see if we qualify. So what I'm saying is that there's a process on that front end there that shouldn't be overlooked, for one thing. Meanwhile, our incomes and cash flows are probably just already automatically deposited into this bank. And yet we still have to go in and see if we qualify. So I'm just saying it's an interesting relationship, isn't it? But that is what it looks like. They will let us know if we qualify. They will let us know how much we can borrow. at what percentage we will be paying interest, the terms, the conditions, the collateral we may front. Again, in this car example, the car will be the collateral. If we don't pay the loan payments back, the bank has the car as the collateral. So those are the steps in that process. There is another way to go about financing things. In that car example, let's say you save up 3 years, 4 years, 5 years, whatever the case happens to be, but you set aside money somewhere for this car fund that you anticipate. So right off the bat, here's what that footprint looks like. You have to delay. You have to have this offset period where you're building up capital, where you're amassing capital. Can't touch it, can't use it. It has to be there when you're ready to get the car. So you're building that up. That way, you can liquidate it once you have sufficient currency for what it is that you're wanting to buy, the car, whatever kind of car it is that you're. So as soon as you have enough money, enough capital build up, you're going to liquidate that and buy the car. Now, you've foregone the approval process and the paperwork, but there's still this capitalization phase that takes place. It's also very important to note that you may or may not be assuming some risk. You may have exposure to things like taxation, inflation, litigation. I mean, fill in the blank. Exposure. You may have risk exposure on your capital. And when you do liquidate it, it's liquidated. It's gone. Okay, so those dollars you will never see again. Yes, you got the car, so you have foregone some of the process with the commercial banking. You're not paying interest, except what you need to notice there is that you have missed the opportunity to earn interest on your money during that entire time of accruing or amassing the capital sufficient for buying the car. So not only is the principal gone, but the earning potential, what can be called the opportunity cost of your capital, has also been foregone in this example. So now you don't have the principal. You've foregone the opportunity to earn on your capital. Yes, you have the vehicle without paying interest to someone else. But what I'm saying is there's a better way. There's a way for you to build up capital where you own and control that minimizes or even eliminates these different exposure risks of inflation, taxation, etc. So it's a place where you own and control. You can compound that capital actually for your whole lifetime. Whole lifetime. See what I did there? You will in a second. And not only can you compound it forever over your lifetime, but you can leverage that capital to access more capital to get your vehicle, to go out and get the car that you want, just like you would have otherwise. But now, because you own this entity, this privatized banking system, you can recapture the money that would have gone to other folks or the money that you would have lost otherwise, but you can recapture that back into your system. So not only can you get the car, anybody can get a car. Go out and see if you qualify or save up the money and go get a car. But can you get a car and get the money back? See, that's what infinite banking is all about. It's the way for you to get the car and get the money back. So at the end of that third scenario, where you've used a privatized banking system to get the vehicle or the vehicles that you want for the whole rest of your life, I mean, walk that process out. What would it look like if you had today, if you had all the money back that you'd ever spent on cars? You still had the cars. You still were able to get the cars. But what would it look like if you also had all the money back from all the cars you'd ever bought? Okay, well, we can't dwell too long there. So we need to think about moving forward. What if, for the rest of your whole life, I had to do it. What if you could buy the cars that you're going to buy for the rest of your lifetime, and yet you could also get every dollar back that you'll ever spend on the vehicles? I mean, how happy are you going to be? And now that type of thinking is what's going to bring us back full circle to addressing runs on banks, banks going bankrupt, government intervention, etc. So let's talk about what's happening currently. Have we seen it before? what are we likely to see in the future? So currently, let's just start currently. Why not? Yes, there have been multiple banks that have had runs on them, that are in the news, that the government is stepping in to make whole the depositors there, the SVB Bank, Signature Bank, and of course now there are just dozens of other banks that are making lists that they don't want to be making because of the unstable sector that commercial banking is. And I want us to understand a couple things. I do want us to understand, how does this happen? How does this happen that there are runs on banks, that banks are having governments step in? What's happening? Why is it happening? I also want us to recognize that it's happened before. So let's perhaps start with that. See, let's just go back to the Great Depression, for example. So 2 or 3 generations ago, we had this Great Depression take place where you had the Roaring Twenties, and there is a lot of interesting history behind this. You need to read behind people like Barry Dyke or listen to folks like Barry Dyke for some real interesting insights, and some others. All of Nash's recommended reading in his book, Becoming Your Own Banker, and his other books, they'll have the authors there. And you had the Roaring Twenties, and then you had the Great Depression take place where, yes, there were thousands of banks in the following years that went bankrupt. There were the runs on the banks. And you need to remember that there's been a lot that's happened since then, okay? We've since gone off of the gold standard. We have since, and in more recent history, had things like the Great Recession in 2008, the housing crisis, that and what it meant in the banking sector again as well. So these recessions and depressions and going off of the gold standard, the dot-com bubble in 2000, and now right up to 2023 at the time of this recording, more runs on banks, more banks failing, more government intervention. So I just do want us to know that this has happened before. Does that mean that it's likely that it will happen in the future as well? I'll leave that up to you. All right, so let's talk about how this happens, how there are runs on banks and how these banks are failing and the government intervention and what that all looks like. So if you want to go in Nash's book and refresh on the First National Bank of Midland, Texas, that's page 19. In 1983, so I was just giving some examples of the Great Recession and the Great Depression and going off of the gold standard and the dot-com bubble and the housing crisis and, of course, now 2023. But back in 1983, so really interesting, decades ago, Nash gave us an example of the First National Bank in Midland, Texas, and there were many banks at that time that were having the same problem that he's describing. But he picked the richest per capita place in the United States to give us one example. So there was a relationship that he described. So for commercial banks, there are these 3 parts that have a relationship together. First, there is capital. It takes something to get any form of a business up and going. Okay, you have to have capital. In fact, that's the one thing that across the board you could say that if a business has no capital, there's no business. So you have to have capital. You can't be too capitalized. You can't have too much access to capital as a person or as a business. So capital is one part of the relationship that should be looked at. The next part is going to be deposits. Banks, of course, want us to deposit. And again, I'll point out, isn't it interesting how so many of us now just direct deposit? We never even see that money before the bank has access to it. And don't get me wrong, I understand the convenience of having cards and being able to do online shopping and online banking and those types of things. I have savings accounts. I have checking accounts. But it stops there. So our deposits are necessary for a bank. And yet, because the bank does say, well, if you deposit here, they have to offer us something. So they're going to offer us a percentage that we can earn on our money, which is taxed. Okay? which which is taxed. We are taxed on the money that we leave in the bank, the earnings that we earn. And of course, banks have fees, processing fees, et cetera. That's its own study to look up the fees and charges that banks have. Very, very interesting. How many dollars every year are charged in fees, et cetera. But the banks need our deposits, and to get our deposits, they have to offer us something. So there is the convenience of cards and online banking, et cetera. So that is what is offered. And then we know that our deposits are then lent out in these loans at multiples. And I could throw different numbers out there. I could certainly say that for every dollar that is deposited with a bank, 9 more are being loaned out. Okay, so just look at this relationship between these three parts of the capital that a bank has, the deposits that are being made, and the loans. And every part's important. Every part's important. And that's what you see in Nash's description of the First National Bank of Midland, Texas, is that they got out of whack. They were skewed. There was not enough capital. And of course, if the folks that are patrons of a commercial bank ever do get a whiff of any instability, and there is even the beginning of a run on a bank, and folks quit making their deposits into the bank and perhaps even begin to want to take their money out of the bank, then you're certainly going to have a weak spot there. Okay, and here's an interesting point while talking about deposits and the money that a bank actually has on hand. Two things. One, if you were making a deposit and you even wrote your name on a dollar, could you come back the next day and get your dollar? No, it's gone. Could you even within the next hour? No, it's gone. Okay, so, and that's fine. There's a natural law of motion. Things that are alive move. Things that are not don't. Our bodies circulate blood. We have respiration of our lungs. Okay, the oceans have tides, etc. Motion's a natural law, so that's good. But this relationship between capital, deposits, and loans really, really matters. Two, I would like to point out when it comes to money that banks have on hand, not only do they not have your dollar, and you will see this with some examples like, let's say you sell a home or you have some larger transaction. And when I say larger, I mean it could be $10,000. It could be $50,000. It could be smaller than maybe you would think. And that bank's not necessarily going to have that money on hand. There might be somebody there that says, well, can you come by Tuesday at such and such time? Because they just don't have the money there on hand. And again, if people begin to think that this bank is unstable and they start to either forego depositing there or also withdraw their money, then that is going to exacerbate the bank's situation, especially if they're already on the rocks because of not having enough capital on hand. And again, here's a good time to point out that banks are owned by people. If you've listened here for any length of time, you've probably heard me say this, but in case you're new, banks are owned by somebody. Somebody owns the local bank there in your town, just like somebody does here in my town, and the credit unions and all the others. Okay, somebody owns that business. It's a business, and that business has owners. So it's the owners that are responsible for having enough capital on hand for the health of the business. Okay, but they're doing business with our deposits. And then, of course, we can get to where we're talking about the loan aspect. Is the bank making good loans? And of course, what you see with something like SVB is that there was a lot of venture capital and startup companies. So it's a really particular bank for the most part. And I don't want to get too bogged down there because, again, here I'm describing all of this to point out the fact that there are many things wrong with the conventional financial system. They are not in our favor. We are not as protected as we're encouraged to think that we are. We are the ones that front the collateral. We are the ones that have to jump through the paper hoops. We are the ones that are paying great amounts of interest, that are filling other people's businesses, pockets. We are the ones that are taking the risk. See, let me go back to deposits and loans and how banks view those. Banks view deposits, even though they have to have them, as liabilities. They are a necessary liability. Banks want us to make deposits there, but they must view those deposits as liabilities. Why? Because they have to do something with that. They're running a business. They have to do something with those loans. And what they do is they loan out multiples. Okay. So do your due diligence on this channel and elsewhere, wherever you would please, about fractional reserve banking. It's a worthy study. In fact, I would encourage you to read the book, How Privatized Banking Really Works, by Carlos Lara and Dr. Robert Murphy, personal acquaintances and friends of R. Nelson Nash. How Privatized Banking Really Works. Great read on the ins and outs of the commercial banking system, what government intervention can look like. Of course, beginning a journey of becoming your own banker to have a solution to this financial dilemma, this paradigm that we're born into, this paradigm of financial slavery that we're born into. So again, banks view deposits as a liability. They must do something with those deposits. And then they view loans as their assets. And this is a really crucial point, especially when I'm talking with clients that they realize this is a good idea. They want to have control and all the different things that becoming your own banker offers them. And they'll get a policy, and perhaps there may be a time where they just pay premiums, and that's good. Again, you cannot be overcapitalized. It's great to have capital and access to it and to be able to compound it for your lifetime. That's wonderful. But also, there is some hesitancy sometimes, especially with my folks that are used to paying cash for things, that they just want to be in a building mode with their policies. And again, that's fine if you're aware of why and how and those types of things. Mostly why. But perhaps they're hesitant to use a policy because they're just so used to paying cash for things and they're just going to be building up this policy. But again, banking is a function. Banking exists, and everything that we do in our households, in our businesses, in any investing that we do, everything is financed. And we could be financing that for ourselves, not commercially, not with cash, but with our privatized banking system. So that money that is being built up in our banking system could and should be used for the things that we're doing anyway. So it's good to fight that hesitancy to actually use your bank, because you must view policy loans as an asset to you if you're going to use that policy loan as an honest banker to finance something that you were going to finance anyway. Because now, if I go back to my car example earlier, again, we're not conventionally financing it. We're not just paying cash for it, liquidating it, foregoing any future use of that capital, but instead, we're growing and controlling and owning and benefiting and profiting from an appreciating asset, which is a properly structured whole life policy with a mutual company that pays dividends. We're able to use that entity as our privatized banking system to finance the car, and then we pay that back to ourselves with interest. So now we have the appreciating asset, the policy itself, plus the car. And who controlled that entire movement of capital? Who's going to profit from it, that interest that otherwise would have gone to somebody else? Okay. Who decides when and how? And it's you. It's you becoming your own banker in that scenario. So it's so very important, and that's why I'm encouraging you to go back to page 19 and becoming your own banker, where Nash is describing that relationship between capital, deposits, and loans. And if I do take another minute here and describe for the clients that we have that are out there listening, view your capital as what you have built up in your privatized banking system. And especially in a time like this, there is a lot of peace of mind. There's a lot of power in the certainty that you can have in having built up capital that you know is compounding. You can access it if you need to. You can use it for your profit, for your lifestyle, whatever it is that you want to do. You're the banker, you get to decide. So you have this capital. Your deposits should be is how you should view your premium payments, your ongoing premium payments, the premium payments to your policy that you make monthly or that you make yearly or quarterly or what have you. Those are your deposits. Okay? So those dollars, they're accomplishing one task already. And then, of course, you have the opportunity to leverage that capital via policy loans for, again, financing your cars, college, vacations, fill in the blank, whatever it is you have going on in your household, business, or investing. It's really a good thing to know and understand that you can be the owner and control and benefit and profit from this relationship if it's in your own privatized banking system. But it also gives us insight into how the commercial banks operate. Maybe they're doing sketchy things with loans, such as we saw in the housing crisis, for example. Maybe they're not having enough deposits. Maybe you're not making enough deposits. Maybe you're not making enough premium payments. I don't know, but that's something that you consider, especially as time goes by. Because eventually you should get to where your premium payments are equal to your cash flow or your income. That doesn't happen overnight, but eventually, over your lifetime, that should happen. So perhaps you need to evaluate your deposits. You know, my wife and I, at the time of this recording, we currently own 6 policies. We've been doing this process for 8 years now, and we didn't start out with 6. That's something that's happened over the course of time because that's what's made sense for us. And you will have your own particular situation as well. And if you feel we should talk about that, let me know. And then the capital. Let's not forget that. What you build up or start with, and there should always be a healthy relationship between the capital that you do have on hand to weather financial storms. Life happens. I talk with folks every week about what can happen in life and how we properly structure these policies to give us flexibility for the downturns and the upturns both. So there should always be this proper relationship between the capital that we have on hand or that a commercial bank would have on hand, the deposits that are going into this system, and the loans that are going out, and keep that well balanced. Now let's talk about how mutual life insurance companies differ from the commercial banks that we know about. So I've had some conversations here recently with clients, some with prospects, and those are different types of conversations, even though we're talking about the same banking crisis that's in the news at the time of this recording. Because with clients, it's the peace of mind, it's the certainty of what it's like to still be making premium payments, still be making policy loans, and the certainty that we can have in banking for ourselves. Now, with prospects, it's about aspiring to that. It's about setting some plan in motion, of course. And how different is that from the general public? For sure. So they're all interesting conversations. I love having my conversations with clients about how different this is, how so very different this is, that with a phone call or an email or by going to a company portal, we can access capital that's been compounding, that's at our control. So, all right, so let me get into how, and if you want to reference Becoming Your Own Banker, the book, that's going to be page 26, where Nash has a diagram there where he's actually showing you what it looks like when a mutual life insurance company is maintaining a certain amount of capital. Of course, they're very conservative. For example, I personally own policies with multiple companies that been in business for well over 100 years. And not only have they been in business and met all their death benefit claims and everything else, but they've paid a dividend above and beyond that for each of those 100 years. And again, we were just talking about a bunch of different times in history where there were World War I, World War II, the Great Depression, the Great Recession, the dot-com bubble. Just think about all the different things that have happened over the past 100 years. These companies have been paying dividends for over 100 years. So to say that they are a conservative financial institution is an understatement. But not only that, because they are mutual companies, that makes us part owners of these companies. So it's really good to understand how mutual life insurance companies are different from what we're seeing happening in the commercial, conventional banking sector. So these companies, they have capital, and they also have an inflow of money via premiums. They also then, of course, because of the business that they are doing, they have investments, and those could be mortgages, those could be bonds. So these companies are able to make really conservative, really secure, really long-range investments. Again, we've got a track record with these companies of at least 100 years. Some with decades more beyond that, 140 years, and so on. So they have in-go and out-go, and that's what Nash is pointing out, is like there's money coming in and money going out, just like in a commercial bank. Premiums are coming in, dividends are going out. Capital is maintained, of course. Money is going out towards mortgages or joint ventures or bonds or what have you. And then, of course, money is coming in from all of those different areas. So we still see that same relationship between capital, deposits, which is premiums to a mutual life insurance company, and then the loans. Okay, so the money that's being put out to work, because that's what a mutual life insurance company must do with our premiums, of course, is put that money to work in a very secure, very long-range thinking way so that they can provide, of course, 120 years from now, a death benefit for a young child that perhaps is just getting a life insurance policy today. And they're thinking really long range, very conservatively, of course, and they are working this same relationship between capital, premiums, and loans and earnings as well, just like a commercial bank is. But so very different. One thing that I would point out, one key factor, for example, is that insurance companies cannot be lending out money for use on these joint ventures or bonds or what have you in multiples of the premiums. But see, that's so very different from commercial banks. See, commercial banks are lending out multiples of the deposits that they have on hand. And that's, again, why? Again, just in case the dots haven't been connected yet, that's what it implies for a commercial bank when there's this suspicion in the air that there may be something wrong, and people begin to withdraw their deposits or withdraw their money from the bank. Now the bank is really gotten in a tight spot because they've lent out multiples of those. Whereas the mutual life insurance companies are not able to counterfeit multiples of the premiums that they... Listen, if you feel a certain way about when I say counterfeit, just remember a quote from Nash. Actually, he would say, banks are lending money that they've made in, and I'm not quoting it exactly, but they're lending money out of thin air, and that's evil. He used the word evil. So it just is what it is. And again, I've said also before, bankers at the local banks, beautiful, wonderful people, great members of the community. But loaning out multiples of something that you don't have on hand, okay, that is what it is. So insurance companies are not doing that. Everything that they are doing is based off of the capital that they have on hand, the premiums that are being paid, the general performance, of course, of their assets, etc. So they're monitoring that relationship between capital, premiums, and then the assets, the coming and the going of buying new assets, others coming to fruition, the earnings from those, paying dividends, paying death claims. So again, reference page 26 if you're interested in looking at that. And again, let me go to the conversations that I'm having anyway, I'm having great conversations with clients. Do you know what my clients are doing? Same thing they have been doing. They're figuring out what they're going to be doing with their policies. They're figuring out their progress with paying off debt or buying the next truck for their business, or is it time for them to get a new policy? Okay, runs on banks take place, and other folks are wanting to know how to get more policies. That's what it's like talking with clients, folks that have actually begun this journey of becoming their own bankers. With prospects, it's okay, they're figuring out that there's a different way. There is a different way to go about financing things, and that they can do that for themselves. We're answering all kinds of fun questions there, looking at each individual situation. I love those phone calls, hearing what folks have going on and showing them, okay, by adding this one step, you could exponentially increase your profitability. You can reacquire the responsibility and the profitability of becoming your own banker instead of having that abdicated to a commercial bank. Okay. And then, of course, we know, those of you that are listening to this type of content, of course, how very different that is from what's going on in the wide world. And again, remember, it's happened before. This isn't new. Is it likely to happen again? Let me tell you something that was really interesting to me. So I'm just a person. I get the emails and I get the text messages and whatnot that you probably do as well. I had a recent promo from a commercial bank, one that you would know if I said their name. And they were talking about a new bonus that they were going to offer. They were saying how if you leave $10,000 in this account that you open up with us for 90 days, you could earn this. If you leave $50,000 in your account, don't touch it, this brand new account that you open up with us, for 90 days, you could earn this. If you do $100,000, you could earn this. Just think about that with me for a second, folks. Wealth must reside somewhere. Sure, I'm going to promote the idea that it should reside somewhere where you own and control, where you don't forego the earnings that you could earn. And I'm not talking about a pittance of 1%. Okay, I'm not talking about a pittance of some tiny percentage. Okay, I mean, I'm just saying, if you gave me $100,000, and I'm not telling you to get, just if I gave you $100,000, could you come up with some ideas that you could be profitable with that type of capital? Okay, if I gave you $10,000, is there a way that you could use that $10,000 to pay me something for having given you the use of it and you still be profitable as well? I'm sure you're a professional in whatever it is that you're doing in your business as a career individual, what have you. There are two ways to earn money. People at work, money at work. So it was laughable to me. Of course, a bank would be more than happy to pay me X, Y, or Z if I gave them access to $100,000 for the next 90 days and if I didn't touch it. Of course they could do that. How easy is that for them? Here was my other thought. My other thought was, why now? I mean, they're always wanting to do that, but why now? Are they feeling the pinch because of what's happening in the commercial banking sector? Are they feeling the pinch if they've got a poor relationship between the capital that they have on hand, the deposits that are or are not coming in, and maybe the loans that they have on the books? I don't know. I'm just saying it's interesting. And when your come from is a place of already being your own banker, that's when it becomes laughable to see those emails. So I hope that this has been helpful for you. Again, my encouragement is to read Becoming Your Own Banker by R. Nelson Nash and to read How Privatized Banking Really Works. And if you'd like to have a conversation about how to implement this system into your household or your business or your investing, then let's have that conversation. If you've had a big takeaway from this particular episode, please let me know down in the comment section below. And I have enjoyed myself. I look forward to our next conversation. Have a great day. Take care. This just in, ladies and gentlemen, there are runs on the bank, there are bank failures, and there's massive government intervention in the banking sector tonight. Thank goodness I'm my own banker.
This just in, folks. There have been runs on the banks, bank failures left and right, government intervention out the wazoo.
I don't think I've ever said the word wazoo on the channel before. That's fun.